So we'll kind of talk as people get in, but yeah, I went to a MBA panel at the IMB in New Orleans, and it was like three legal experts, and they gave them a half an hour, and there was basically one question that was asked. So we'll try to get to as much as we can today. We'll see how much we can get through with five
Yeah,
people.
this is our biggest crowd we've had, so this will be fun.
Yes, but for the people that are trickling in, welcome to Mortgages with Millennials. I'm Robbie Kristin. I'm Rob Chrisman. That's Kristin Messerli. Robbie Kristin Messerli is our full name. It's like Malcolm
That
Dash
was
Wiley.
great.
Yeah.
So welcome to the people that are here so far. We're very pleased today to talk about the future of mortgage. From FormFree, we have Brent Chandler. From HomeRun, we have Tony Wilbert. And from Stairs Financial, we have Malcolm-Wiley, Floyd. And as people get in here, I do want to start by saying a big thank you to FormFree for being this week's sponsor of Mortgages with Millennials. FormFree supports lending for all people without bias with FormFree products, Passport, and Reiki. Consumers can access the credit market with anonymized data regarding their ability to pay and establish their borrowing power. Additionally, FormFree Exchange is a new marketplace that brings together lenders and high-intent financially vetted borrowers who need them. If you know someone that would benefit from a fairer way to measure credit, visit formfree.com to learn more. Yes, Brent, big thank you to you. So I guess I'll start with you. How you doing today, man? I love talking to you.
Yeah, I'm grateful. I think that's the word of the day for me today. Thank you for having me. And this esteemed group, excited to talk about, what's going on and really get into some of the solution. I mean, we focus so much on the problem, but I am the founder and CEO of FormFree, been at it for a little while. And as you mentioned, we're a tech company with purpose. So yeah, our purpose, which, mission-driven company, is really to democratize lending for everybody, inclusive, fair, equitable lending. And how do we do that? We've set up a solution, created technology using the latest AI and NLP, and been working on that for a while, but removing bias, stripping out the bias and really showing the true elements of the financial DNA of the consumer. And that's captured in an index that we created called RICKI, Residual Income Knowledge Index. And that actually corresponds to a FICO in delinquency. So we'll take you through a lot of that, but effectively tech with a purpose, mission-driven, democratized lending.
Awesome. Malcolm. Oh, sorry, Kristin, go ahead.
Oh, I was just going to say that each of you represent a really interesting part of this solution and the future of mortgage. And, would love to hear, yeah, you're getting there, Robbie, but each of your missions at your companies, and we'll get into some of those solutions as we go. So Malcolm-Wiley, Floyd, you're up.
Absolutely. Well, thanks for having me, guys. I'm Malcolm-Wiley, co-founder and CEO here at Stairs Financial. Stairs Financial is a mortgage marketplace that connects really young first-time home buyers with lenders who can help them buy with down payment assistance, with first-time home buyer programs, with all of these new and exciting loan products that come with special benefits designed to really lower the financial bar to becoming a homeowner, right? So we talk about mission, and I think we're going to share a lot of pieces of our mission here, right? But our mission here is really to create more home buyers by educating them and really introducing them to the existing new products that exist to really help folks sort of go from 0 to 1, sort of get on the property ladder that we're really excited about. And so a big piece of that mission is really, is proselytizing, is teaching more consumers that, there are more options out there. It's not just, 20% down for a conventional mortgage, right? You have other tools in your toolkit, and really finding and working with lenders who are excited to engage those, future clients for life to really sort of get folks into a starter home, into their first property, so they can then, build wealth and be a part of their community.
Cool. And Tony, Mr. Wilbert, how are you doing, man? Give us a little background on you and HomeRun.
Sure. Like Brent, I've been in this space for a long time. And I think that FormFree and Malcolm-Wiley, it sounds like you're doing some great stuff as well. But Brent certainly has been at the forefront of leading this idea of a persistent profile and sort of which was the gateway to a marketplace. We are building a platform at HomeRun that is maybe simply stated that people buy homes, they don't buy home loans. And so while, educating the consumer about a loan is a good thing, most of the time they don't do it until they're starting to shop. So we're bringing this idea of the MLS and adding that data to a lender marketplace or a persistent profile so that, the buyer, the seller, and the agent, can interact with a loan at the point of search.
Awesome.
Yeah,
so
we should talk.
Well, I'll get you two connected after the show. Don't worry. But I was reading through some of the questions that I had made up for this show, and the first one was about, is it a stretch to say the current origination model for mortgage is broken? I feel like that's a little harsh way to put it. And Brent, I don't want to harp on the past, as you said. I want to look toward the future here. So maybe I'll reword that slightly and say, what do you think needs to be improved and is improving about the way we're originating mortgages, especially now that we're at the bottom of this cycle and hopefully it's on to new and better pastures going forward?
Yeah, I was gonna, in thinking about this question, I was thinking about, is it broken, or it actually works? It's just inefficient. And if you call something inefficient, it can easily be led to it's broken. It does work, and history has shown that a lot of people have had success with it. But the thing that I see with it, and this is after a lot of kind of my own dealings, not as an originator, I'm a cog in the wheel, if you will, a part of it, is just the layers and layers of abstraction that have kind of taken us away from that village banker mentality, which essentially said two people would know each other and know everything about each other. And it comes down to risk. So all the layers in between, which are an attempt to create a safer, more inclusive lending environment, have actually worked against itself and created a tremendous amount of added unnecessary processes, which then cost more money. So we look at it as going back to zero. If we want to try to fix a big broken system, or a big inefficient system, we have to begin to realize that, the world is ever changing. It's never constant. To think anything's going to stay the same for 100 years, that's just not the way it's going to be ever. And history will prove that. So we have to adapt, and we have to be willing to change. And it requires people to embrace that change. The resistance to change actually creates suffering, believe it or not. And so change is upon us. We all know that. We're seeing the likes of ChatGPT, AI, Bitcoin. I mean, for what if you want to get on that conversation, but these are some of the fastest growing technologies ever in the world. It's a swarm. It's a viral effect. And so I think it stands to reason that change is upon us. So how do we embrace that change? And what are the steps we can take to create a more efficient system? And I boil it down to one word: risk. I think it really comes down to that borrower and that loan. If I can afford it and I can prove it, then I should get it. And I really don't want to get the loan. I want to get the home. Right?
Brent, I think a lot of what you're saying makes sense, but I do want to push back a little bit on, whether origination is broken and whether it works, with a question as far as who is it working for right now. I think the system works for some folks right now, for existing home buyers with some wealth, with some income, with, standard credit, right? So that they can be underwritten traditionally. I do think the system works pretty well for them. But when I look at, the millennial generation, the Gen Z generation, and I look at the challenges that they're seeing and they're facing to buy a home, the system isn't working as well for them. And more importantly, it doesn't feel like it's working for them. You know, we talk to so many users who say, oh man, I don't know how I'm ever going to be able to afford a home. And so I think maybe, you know, whether the system works or it doesn't, it's a problem if the people who we're trying to help doesn't feel like it's working for them. You know, and I have a lot of respect for the work, you know, that you're doing specifically around expanding access to credit and being more flexible and creative and thinking about different credit underwriting solutions. And I think that's a really important part of the problem to sort of help, you know, the system work for more folks. And I think, you know, for the work that we're doing on our side here at Stairs, it's really around, you know, the down payment, right? You know, if the system used to work that you had 20% of a home and you could just walk into the banker, to your point that you knew on Main Street, hand them over the 20%, get the mortgage, get the keys, that would be great. That's not where we are, right? You know, I think the average first-time home buyer, you know, is only financing, or excuse me, is financing 93% of their home purchase, right? So they're putting down on average 7%. And we're seeing home prices continuing to, you know, rise or stay high while income has remained comparatively stagnant. So as you're talking about the change that we need to make in this industry, you know, I think one of the things that we're really passionate about is making sure that, you know, the mortgage products that we are introducing sort of support those different new realities.
Yeah, I think it's a great point. And I also would ask you that, you know, just a counter question to your comment about, you know, the origination process being broken or not working for, you know, the millennial generation, as it relates to one particular item that you touched on that I'm very passionate about is that scoring mechanism. You know, it's that access to credit. And would you define that as a barrier to entry for the Gen Z, the millennials?
I mean, yeah, absolutely, right. I think, you know, I wouldn't be breaking news in a meeting like this to talk about some of the shortcomings that we see in traditional credit scoring, right? And I think a lot of people are working hard on products both to improve millennial and Gen Z, you know, credit, whether that's the rent reporting folks, whether that's, you know, sort of the credit builder apps and sort of starter credit cards, or whether it's, you know, the credit repair folks and the folks who are working on that, right? So a lot of people are working on, you know, how can we get, you know, that number higher, which is great and really important. But to your point, it's all kind of a part of the origination cycle, right? You know, if you know, for our lenders, right, you know, we're looking at files based on income, based on credit, and there are so many ways to make those evaluations, right? Is credit, you know, a barrier for young folks? Absolutely. You know, is income a barrier for young folks? Absolutely. And is purchase price a barrier for young folks? Absolutely. Young folks are in a hard spot right now. So ultimately, you know, I think, you know, at Stairs, we're really excited to sort of be a part of the solution, but we're going to have to get this right in a bunch of different spots on credit, on income, on affordability. We all kind of have to work together on it.
I think this is a good transition to talk about where each of you are coming from in terms of being a solution to this problem. But as we get into that, we'd love to invite the audience to chime in if you have thoughts on where, you know, where or if the system is broken, what some of the challenges are, and we can talk about those. I also want to share just briefly a couple of slides on some of the research that we're seeing. To your point, Malcolm-Wiley, about the feeling of the next generation around homeownership. I mean, we've found over and over again that people don't feel confident in their knowledge of buying a home. People don't have the financial literacy. We have a first home IQ quiz that we've talked about on the show before, and seen that Gen Z scores a 48% when it comes to their ability to answer questions correctly about how to buy their first home. So it's not, you know, it's not good when it comes to that. But the big area I wanted to touch on here was their confidence in the housing market and their confidence that homeownership is accessible to them. So even if some of these solutions are in place, I think there's a general feeling that this is not accessible to them. Only 41%, so 59% said that they're not confident homeownership is going to be accessible to the next generation. And this is 1,000 millennial and Gen Z consumers reporting this information last month. So we hear over and over in the news and media that this is, this is not accessible, that you shouldn't even try to buy a home. And this is from New York Times, Fox News, across the board. I won't get into it too much because I want to hear from you guys. But there's, I think there's a general disheartening feeling from the next generation that this is, this is out of reach. So I would love to, hit on, because each of you are representing very different areas of the problem. So, let's start with, Malcolm-Wiley, you started talking a little bit about the solution. So I want to pass it over to Tony. Where are you feeling that you can see, where are you solving for this, this challenge for the next generation?
Well, so thanks. I think that it's affordability is a key issue. And, I think that you're doing a great job of trying to be at the forefront of literacy and, doing right by people. I think it's ambitious to suggest that financial literacy, is going to happen before the point of search, before their interest level. I mean, again, it comes down to people buy products, they don't buy loans, right? They get interested in something. And I think we can do a lot better job at teaching people to become literate at the point of search, at the point of interest. And, I think that, Brent started the conversation by saying that the system, it works, but it's inefficient. And, I would say on the financial literacy part is that it isn't working because it's so opaque, right? And so those two things, the opaque nature of the space and the inefficiency of the space is, challenges. I actually think that the solution is that hard to conceptualize. It takes 20 minutes to go on Airbnb and search, share that listing, and rent the property, that you want. It takes 2 months to do the same thing with Wells Fargo. That's the inefficiency that Brent is talking about. I think that, to just go back and give these concepts of Brent's medallion, or what we call a persistent profile, like that shouldn't be very hard for lenders to understand. They should accept Brent's medallion, or they should work with a platform like ours and be a correspondent, provide a correspondent program so that we can provide rates at the point of search. We're building a platform where you can show, you can search for homes. An agent can search with their client any home in a region, and as long as they've given us their profile for income, asset, employment, and debt, we'll give them real-time rates on homes that they're viewing in real time. The idea of how this affects literacy, Kristin, is that they should be able to do that. A buyer, whether it's a millennial buyer or other, do that months before they're closing a transaction. They should be able to learn early in the process with real numbers, not fake numbers, with real properties that they're interested in. They should be able to see where they are and where they need to be for a down payment. So, I won't pontificate, on it, but I think that Airbnb has done a great job of showing us a platform that works for searching, sharing, and renting a property. It shouldn't be an order of magnitude or more difficult to search, share, and buy the same home.
You bring up a really good point around transparency. I mean, just the fact that this is not something tangible for us to be able to see really clearly. And Brent, you're doing incredible work around this. I mean, it feels out of reach because we can't see what could be in reach, even if it's 5 years down the line. Robbie, I think I cut you off. What are your
No, you're good. I was going to say, whether it's affordability, supply, some credit stuff, maybe there's ways to cash flow underwrite. Where do you three see the space evolving towards? Brent, how do we get some of these inefficiencies out? What does the future of mortgage origination look like to you in 5 years, 10 years, 15 years?
Wow. You really want me to go there? I mean,
why we're here.
Push button, get loan, man. I mean, the inefficiency doesn't belong there. And to William High's point, I would say that there's a huge elephant in the room that is effectively, prevented so many African American, Latino, whether millennial or not, people of been discriminated by the system. And there's literally one number that the NBA quoted. It's a 2022 number, but effectively average FICO for homes that closed in 2022 was between a range of 730 and 750 average. The 86% of Black households in this country hold a 680 or lower. And we talk about a wealth gap. We talk about disparity. This has happened since 1968. The wealth gap has expanded. That's unconscionable to me. What we address is removing that bias. Recently, a top credit union has been in the news for some discriminatory practices on lending. It's just got to end. I mean, so, we aim to tackle that through, verified credentials that remove bias, that capture a consumer's ability to pay by analyzing their financial DNA. I mean, it's what we did $4 trillion on with account check, which we divested about a year ago. That process was baked into the origination system that I speak of that's so abstract layers. We were just one cog, like I said, one spoke in that wheel. And in order for us to reach the demographic, the people that have been excluded, we had to jump out in front. And that's not an easy task, I can tell you that. But because we're passionate, because we're mission oriented, because we stand strong on evolutionary tech, the removal of bias in that medallion anchored on blockchain that enters an exchange where lenders can bid freely on a qualified borrower, because the data underwriting that medallion is effectively the same data that we achieved day one certainty on, rep and warrant relief from Fannie and Freddie, FHA, VA. Yeah, we're giving the power to the people, empowering people and consumers with their own data so they can know before they enter into a loan that they can afford it. The education can come in. I mean, we want the education. The app is free. We want the education. We want to empower and educate people on knowing what they can afford. No longer should I be reaching for that, $1 million home when I could only afford the $300,000 home. And to each point, why am I looking in that home? What if I knew I could only afford 300 and I could do that comfortably because I have the residual income to prove it, and the data is verified? Then and so I do think that that's our fix. I mean, that's the fix. And where that goes, a medallion is anchored on chain, is an immutable transaction. It's unchangeable. It's unalterable. You can't touch it. There's no humans in it, and it's assessed with that residual income. So if you can imagine, I can underwrite that medallion. That should streamline all the way to secondary. It's just one dot. It's one data point of risk that says this borrower is good to go. And that goes all the way through. And because it's an immutable transaction, that transparency of the underlying data, which is massive, is all exposed, just not with the bias, until such time as the borrower says yes.
So I think that's an exciting vision of where we could go with more efficiency and more transparency. And I definitely think that that's part of what's coming up the works as far as helping new people become homeowners, right? I think we also need a proliferation of new mortgage products to be able to ultimately get more folks in homes. Just because if you look at even the example you just showed, right? Let's take something like Ricky that says you can afford a $300,000 home. There are places where you can't find a $300,000 home. There are places where, ultimately to be able to finance a $300,000 home, you need more savings than you can reasonably have, or you can build over the years that, people have the jobs that they have and the student loan payments they need to make, and just like the changing participation rates that people have in this economy. So I think we have to solve the part of this that you're talking about. You're absolutely right. We have to make sure that there's more efficiency and, and more transparency in what people can afford and how they can afford it. We also have to build new ways to afford it, right? And I give a lot of lenders credit. There's been a lot of focus on special purpose credit programs, to your point about the gosh, the really depressing inequity that we have in home affordability, especially for Black and Latino communities, right? People are creating these new programs. We're naturally pretty invested in that. So we track and we see the new programs coming up every week and every month, right? And so I think we do need both parts of that puzzle. We need, easier ways to get into loan products to be able to afford, but we also just need more products. So to answer, your question, Robbie, as far as, where do I think we need to go as an industry? Push button, get mortgage. Yes, sign me up. But this idea of mortgage, it can't just be conventional. It can't just be, the sort of 4 or 10 products that we have right now. It probably is hundreds. It's probably way more kinds of mortgage products that, specifically fit the economic realities of the home buyers of today and tomorrow.
Tony?
Look, I think that I love the idea of the medallion concept. And, we worked on something similar to that about 10 years ago that would go, all the way from, start to secondary markets. I think the realities that I've learned in the space is that 200 million people are viewing Zillow each month. They're shopping there. 93% of homes use a real estate agent today. And it's important for lenders to look at these people as your educators. If you're interested in sort of the affordability or the fairness issues. What I think really needs to happen is a medallion or a persistent profile needs to be embedded at the point of search where the MLS is happening. I think that's the trying to educate outside of where the user already is and is already transacting is an expensive value proposition. And, I think that just making it simple and saying, hey, if you're interested in this home, this is what your options are, is an approach that hasn't been explored at the level that it needs to. I think it's almost as simple as that. Can you teach people about what their buying power looks like and what their affordability is when they're really interested at the point of search?
That's a good way to put it. Brent, I want to follow up on something you said quickly here, and that's, you mentioned the phrase "no humans" in it, or referring to the process. I think a big chunk of our listeners here are originators, or on the originator side of things. So what does the future of the LO look like to you? Because they do provide a lot of value to borrowers like having their hand held, but on some level, with the advances in technology, there's a lot more data entry stuff that can be automated. So how do you see the LO evolving going forward?
Yeah, I think, I don't know that no human, what I meant was no human can actually manipulate the data that we're delivering, but I do see a digital process end to end. Yes. I do think there's a role for the loan advisor. I think a loan officer, I think it morphs. I think as our industry changes, so do the roles of the people in the industry. And, we kind of saw that in the brokerage space. I was a stockbroker back in the day at Merrill Lynch, and we became financial advisors. Remember when I got my new business card? It was an overnight thing, and the space changed dramatically, very quickly. Brokers turned into advisors, and it was very efficient in the sense that the role was a little bit different. We went into managed money. We created services that we supported, but that were less hands-on. So you could imagine, as this cost continues to balloon to do the underwrite, there's ways to create more efficiency around the roles of the human in the process. And so by having that construct of data up front, immutable, transparent, that meets the guidelines in the back, it doesn't make sense to get it here and then do it again. So eliminating some of that process, I'm not saying eliminating all of it. I think there's some very necessary parts of a loan process. A big loan, it's a house, it's a one-time event in some cases. It's a big deal. You want somebody there coaching you through it. Yeah, I think that's going to morph. It has to. It just has to. It's not even an if, it's just when. And I think it's a good thing. I think lenders want to lend. The stuff in between is just it's the necessary evil to get it through the process until the process changes. So we're attempting to change the process. It's a heavy burden. But I want to give a picture of how you could see it differently. In our world at FormFree, we think it's kind of weird to have to go into debt to get debt. We think the whole idea of building credit on a credit card as a young person to establish some sense that you can get a loan is weird. Like, if you're fiscally responsible and you save your money, you're not spending on a credit card, like I've done in the past and blown myself up. You're fiscally responsible, you should be rewarded. And what's fiscal responsibility is looking at residual income. I mean, are you saving or are you spending? And why does it matter if I build a credit card that shows I paid the bills back when I actually can show in my real-time life, yeah, I'm saving money. I'm stocking some away. I've got a couple different jobs that are gig economy, those aren't always tracked. So yeah, there's kind of a different way to think about how that individual, that millennial, that young person, or anyone for that matter, has a bad credit because I screwed up. Something happened. COVID hit. Recession hit. I mean, there's so many reasons that were not in my control that I was impacted adversely, and that screwed me up for a long time. But I got myself back on my feet, and I actually pulled down 2 jobs, and I have residual income, and I'm paying my rent on time. And rent's a big nut that you don't get a lot of credit for. We look at the rent. We look at these things, these items that show your residual and discretionary income and can prove you can afford this loan. Unequivocally, you can afford it, and you can do it, and you've shown that over a year. And so why wouldn't that? So we bundled that up, and why couldn't that be a representation in addition to credit? I'm not saying throw credit out the window. I'm saying with the fall of credit and its importance, the rise of asset, where the twain shall meet, you have nirvana. When I can see all these components together, I see the holistic human. And that Ricky attribute is essentially another indicator of risk and delinquency in the sense that says, hey, this person's got a Ricky index of 110, which shows they're saving money on a month-to-month basis. And that corresponds to actually a 750 FICO, but they only have a 680. I mean, yeah, they have a 680, but I can't even enter the door because they're looking for a 750 or better. So we're trying to show, like, it's another attribute of risk that really truly assesses me. They didn't know me when I tried to get my loan. When I founded FormFree, they made me give them all this paperwork, and I'm like, can I just give you all my information digitally? I mean, that's what I did. And they said, yeah, that's a great idea, Brent. Fax it over. And I was like, okay, I'll go build it.
Robbie, before we move on, I want to get back to your question around the role of the LO here, right? Because obviously, we're all technologists, right? We build software, and so I think early on when we were developing the Stairs platform, we wanted to build something that consumers could take as far as they can, on their own, get the information, start to work towards the loan. And time again, we did user interviews, and we would always ask them, like, okay, at this part of the process, what do you want to happen next? And they would always say, I want to talk to someone. This idea that, even, as we build software to Tony's point, to sort of help folks figure out what they can afford, sort of closer to their property search, as we think about, alternative credit, no matter what, this is the biggest financial decision a lot of these people are making in their lifetimes, right? And so they're obviously going to want to talk to someone, to talk to an expert. And I think that, part of our job as being technologists in this mortgage space is making so that as much of that time can be spent on conversations, moving the ball forward, on conversations that are specific and tailored to a home buyer, right? So that, if, on our Stairs platform, right, like we can give consumers all the different options that they have, all the different, avenues to get down payment assistance, to get different credit underwriting opportunities, right? So that when the consumer has that conversation with the loan officer, they're already educated, they're already bought in. So then the LO can say, okay, let's tailor this just for you. Let's talk about like, okay, you want to use this program? That's great. Let's talk about the timing. Let's talk about, okay, like, are you working with a real estate agent? Do you know where you want to buy? There are specific geographic barriers for this program. So let's make sure you buy there. And so instead of the conversation, happening all the way up, like this is an interest rate, this is a mortgage, have you heard about, FHA? So that we can make sure that those conversations are focused on how can these LOs add the most value and really help really put these consumers at ease, right? That's another thing that we hear a lot. Even with first-time home buyers who get over the line, there's a lot of anxiety associated with this purchase for first-time home buyers, right? And so the role of the LO is to really help, sort of elucidate that, address that, and sort of be that trusted advisor for the home purchase. And there's no technology that can replace that.
I love that framing around like, how can we do our best at being there for the consumer? And that is going to include the best technology and the best time spent with the consumer. I want to address some of the questions, have some really great conversation happening in chat.
Kristin,
Yeah.
we let Tony talk about the LO real quick before chat stuff.
Yeah, sure, of course.
Sorry. Tony.
Well, I think that, there's 5,000 lenders that are providing overlay criteria onto a Fannie Mae product. And yes, the role of the LO is to reduce anxiety, but they're also creating the anxiety, right? It is so difficult to figure out what all of this stuff means because no lenders are publishing it, in a transparent way to consumers, right? And I'm not, a 30-year mortgage lender, so I'm sorry if that's comes across the wrong way, but some lenders have to lead and they have to be transparent with their rates and they have to be upfront and they have to be and get rid of the opacity that exists and become transparent and say, hey, look, our LO really is trying to help you get in the best position, and that hasn't happened historically, in all cases, right? And because there's 5,000 different, versions of this, the real estate agent is confused too. They have to close with 5,000 different processes. So, that is not what Airbnb did. That is not what Kayak did. Kayak shows transparent rates from all the airlines. And you can search, share, and book a flight in a very short period of time transparently. And you can choose United if you think it's better than Southwest, and pay a little bit more. I think that the role of the LO and the role of the lender in the future is, the marketplaces are going to exist, whether it's Brent's version of a marketplace or an Airbnb version of a marketplace or it's going to the marketplace exists. Even Zillow is trying to become more of a marketplace for loans than they have been. So, I think transparency is the future. I think that the real estate agent has gotten a lot of harpoons in their back because they have a lot of fees. And I think one of the big problems is that lenders haven't been clear about their fees, and that's providing the anxiety, right? So again, I don't want to pontificate about something that maybe this audience isn't so open to, but the idea of a few forward-thinking lenders to create correspondent programs that would work on a transparent basis with platforms, I think they are going to lead the future as far as what a solution looks like that is in the best interest of affordability and transparency and all the things that you've talked about in past podcasts, Kristin. All of those things, it's not, the solution isn't that hard. Lenders, go show your rates up front, if it's created via a medallion or whatever it is, a persistent credit profile should be able to be established, and people should be able to see their rates at the point of search. It takes us a fraction of a second once someone is underwritten for income, asset, employment, and debt to show them their rates on a home. It's not a technology issue. And Encompass can't do that, but a new platform and new technology certainly can put MLS data together with LOS data or LOS underwriting rules.
Well, I think each of you have done a lot towards, talking about making homeownership more accessible and really putting the power in the hands of the consumer. I want to touch a little bit on some of the questions and conversation and chat around how in the process of potentially, democratizing lending or creating that possibility for homeowners, that there's a higher risk or lowering the bar. And I just want to touch on or address some of those concerns. There's a lot of new products that are available, and we've talked about lowering or expanding the credit box. So as we do that, and we've had a question around, by making or addressing some of the racial wealth gap, is that going to lower the bar and make the risk higher for people? So I wanted to share a little bit, these are a couple slides from past presentations I've done, where we see the racial wealth gap is so significant. It isn't something that we can ignore. I mean, the 84% of millennial homebuyers are white, but the problem is really comprehensive. It's not something that, I think can be just said, okay, if we do this one thing, it's going to address this. It's obviously systemic and also comes from a huge history that we have. But one thing I wanted to point out is that the parental median wealth gap is significant. For white millennials at the age of 30, the parental median wealth is $84,000 versus Black millennials at the age of 30 at $15,000. So, Brent had talked about how we have if something hits us, there's going to be more support for someone that, it already has that kind of accessibility. So I wanted to, put this out there to the group. Does anyone have any thoughts on how we're, expanding and making homeownership more accessible, acknowledging that there is there's a nuance here and a lack of support for, not every person, and also how we're making that, we're not, just increasing the risk.
Yeah, I can start. I mean,
Good.
I think the point about the bank of mom and dad is probably the important place where I want to start. I think, especially here at Stairs, we work with a lot of millennial home buyers who kind of done, everything that they're supposed to do, right? Like they went to college, they got good grades, so they got a good job, they were responsible enough, with their credit. And then they show up to this point of young adulthood. Maybe they just got married, maybe they're expecting a child, and they were kind of told if they checked all of these boxes, the reward at the end of the line would be a home, but there's a gap. And that gap was ultimately a small fortune. Right? If the average, home price is, $500,000, a 20% down payment is $100,000, right? And so and for a lot of home buyers who are successful, who the system works for today, they call the bank of mom and dad, right? And that's sort of how they end up transacting. So what do we do for folks who don't have that resource, right? And that's, naturally our focus here at Stairs. So, for example, right, we have, somebody who's trying to buy a $300,000 home, let's say in Texas, they have income, they have credit. And like we mentioned, the target down payment, the average down payment for first-time home buyer is 7%. So it's about $25,000, right? It takes a long time, especially, with expenses, with rent, with credit payment, to save up that $25,000. But with some of these down payment assistance resources that we have programs where people can get $10,000, $13,000 in a grant, in a forgivable loan to get them across the line. So what does that actually mean for the home buyer, they're buying years earlier. And so they can start building that wealth as they can sort of get on the property ladder with, less risk than they would otherwise have, right? Because they do have more equity in the home they would have otherwise, right? So that would be, how we think about our work here at Stairs and how we work to address some of those gaps that you're talking about.
That goes back to our earlier conversation. If people understood this or had this information, that's not going to solve everything, but it does increase accessibility and that general, feeling that this is something available to them in the future.
Absolutely.
Brent?
Well, I think the big question that I'm hearing is does lowering the bar introduce more risk? Lowering the bar according to what? And that's the question, right? Are we lowering it according to FICO? Is that the standard? And if that's the standard, then it's clearly, left a lot of people out. And I know for a fact that loans can be bought down to 550. And what if a 550 is carrying a Ricky of 110? I'm telling you, it performs like a 680 or a 720 or a 750. Residual income, it looks at things that are actually real in life that are happening over a span of time that's indexed. And so it's not just look at my residual income this month. It's literally over a span of time, which is looking at the transaction history at a granular level. Now, does it introduce more risk if the person doesn't go delinquent, but they have a low FICO? I would argue no. And so the idea that we just keep a threshold of what worked in the past is going to work in the future, that's not going to work. We've got to look. And by the way, the reason we have such vast swings in our industry, ups and downs when interest rates move, is quite frankly because we just have such a narrow market of buyers and sellers. It's the same demographic of people that are moving it. So when they come in, they come in. When they go out, they go out. If we expand that, we soften the curve, which means by adding more people into the space of the home ownership at different levels, you're going to increase. You're going to soften those dramatic inflows and outflows. So we need to think about humanity. We need to think about these issues that you've raised, right? It's a problem. Director Thompson says it's a number 2 pillar in her administration. This is coming down across FHFA, Freddie, Fannie, across the government agencies completely, and we're not doing anything about it. I would say that changing your FICO and getting more granular on FICO and giving them more data, that's not what I want to do. These are people that are taking my data, making money off it and telling me how good or bad I am. My residual income's mine. That's mine. You don't get it. CFPB weighed in. The consumer is the owner of the bank data. The bank is a fiduciary of the consumer. That rule came out. That's a good thing. It means I'm empowered with my own data. So we've got to think about these people that have been left out of a conversation for far too long and address it head on. And that's what we're doing. It's not going to introduce more risk. It's just not the system that you know from yesteryear.
Tony, real quick.
I think that, what Brent's saying is amazing and ideological. I think the reality is that Fannie Mae is the underlying rule maker for a majority of loans. And so, the inefficiencies that exist in the marketplace, there's still a whole bunch of inefficiencies that are, directly related to the complexity of overlay rules on existing Fannie Mae product. And so, yes, maybe you can just leapfrog over that or change criteria for credit decisioning. But, I think the future of mortgage is, especially given, the state of the market today, is about making, progress as the current reality states that, thousands of lenders exist in the marketplace, and they're struggling to compete against each other. How do we make that process more efficient for the buyer to understand what their buying power looks like? And that I don't think that we need 5,000 different lenders. And it given the interest rate increase over the last few years, I think that there's probably going to be a consolidation of that marketplace. So, after the aftermath of who survives the current situation, I think the question is, how do you move forward with what's left? And if we can get to an idealized state and include more borrowers, I'm all for it. That is primarily driven by government backed security at the moment.
Go ahead, Brent.
I just want to comment, and I appreciate that vote of confidence.
Yeah.
Ideological and mission oriented. That's who I am. But I think the same was said back in 2014 when we got acceptance with D1, Fannie and Freddie, and then 2016 when they announced rep and warrant relief on the automated asset verification. And what I would tell this audience also is that we are currently in a pilot. I can't disclose the entity, but I will say that spring eternal.
Yeah, I don't think that, just to comment, like, I don't think that what I'm saying is mutually exclusive from your vision, right?
I was being sincere.
Yeah, I think they're one and the same. And I think what I'm suggesting is that, like, Brent is talking about the future, and I'm just talking about reality as it is today, and like trying to improve. There's so much improvement that can be made. Let's be realistic. The Priceline and Kayak came out 25 plus years ago. Airbnb is 12, 13 years old now. These user experiences are being used at scale, and it should not take you 20 minutes to book a home for rent in Nevada, in Reno, Nevada, and take you 2 months to buy the same home.
Look, you can go out and buy $1 million in Bitcoin like that right now.
Yeah. And so I'm, Brent, I'd love to,
on leverage.
We've actually used, your products in the past, and at a different company. If we can help accelerate that, I think that would be great. The vision of what you're talking about, use your products. Again, the reality is that you've got these mega companies. You've got these the Zillows of the world, the Wells Fargos of the world, and the Rocket Mortgages of the world. And that is the view of a mortgage today. Mm-hmm. And they do not feel pressure to change because there is no pressure to change. The efficiency, is not there yet. The inefficiencies that you talked about, Brent, exist, and they're significant. Mm-hmm. And the opacity exists, and the ability for, some lenders say, oh, we don't want to, show our rates because then people just rate shop with us, right? Well, that's not necessarily the case in a systemic, system where, maybe an agent is helping to guide a transaction, and hold a hand, alongside a system with a transparent set of rates, right? And it could be a win-win-win for the buyer, the seller, the agent, the lender. It might not be a win for all 5,000 lenders, but it certainly could be a win for those that are taking a principled approach.
Sure. And William Hyde, I would say this: when we go collect information about that consumer, permissioned by them, we're looking for DPA, and we could effectively, literally, feed some of that information back to you if those folks aren't ready to move immediately. And so I see this world, it's a partnership, right? We're all bringing something to the table to create a better world for those that have been disenfranchised, left out, or, kind of a system that needs an overhaul. So it's going to take us. And I'm telling you, it's not easy, is it? I mean, you guys know, Robbie, Kristin, I mean, it's a grind. That's what we do. We want a better day. We want a better world. We're going to be a part of it. We're all bringing our piece.
We're very
Together we
thankful.
can do it.
We're very thankful that all three of you could join us today. We actually went 10 minutes over time because we were enjoying the discussion so much. So I was going to let you guys conclude with sales statements, but I will just say for people that want more info, homerun.com, steersfinancial.com, formfree.com, and a big thank you to FormFree. Forget Steers and Home Run. Big thank you to
No, thanks everybody.
but everybody was great.
Yeah.
Kristin, any concluding remarks before we see people next month?
So yeah, I could talk to each one of you for a long time, and just so appreciate you guys taking the time, and for everyone in the chat for contributing your thoughts and questions as we went through this really, big topic.
Big stuff.
Thank you for having me.
Thank you. Appreciate y'all.
Bye.